you guys have a bunch of funds out there, right? And there is probably no one size fits all. But assume some hypothesis that the viewer who is watching this is between, let's say, 30 and 50. Both male and female viewers watch this. They are mid-income, reasonably well earning people in their own right. And if they have to make mutual fund allocations at the current point of time, looking at what's happened in the last 2 months, hypothesizing what could happen over the next 10 or next 22 months, whatever, if you take a 2-year view, what are the kind of funds from the Axis stable that you believe are best suited for a well-diversified portfolio?
I think all Axis funds are well diversified, Neeraj, so I don't worry about that. It's just that depending on the risk appetite and the time. I mean, this is a public show, so I would actually, you need to give me more data on the investor. But let's say if the investor has a let's say 3-year to maybe 5-year type horizon, maybe a balanced advantage fund is a better place to be in. If he's got a 5-year to 7-year time horizon or 5-year plus, I think a blue chip is fine. Blue chip, flexi cap. It's slightly more than that. I think anything between a multi cap, mid cap, or even a small cap is fine. And small cap, obviously, I'll give a little more time more. Give it maybe 8-9 years more, because for 2 reasons. I think you need to get the story right. You need to allow stocks to perform intrinsically, get their valuation, and then obviously the price follows. Lastly, of course, if people are fond of passive management, I think there's a whole host of good index funds available with us. We have a mid cap 50, which we are launching on Monday. We have a small cap 50 which closed yesterday. These are index funds with a little bit of quality and liquidity that we put in. And then of course my hot favorite, the Nifty 100 and the Nifty Next 50 are always there available to you. So it's again a mix, Neelam. And lastly, let's not forget debt, because I think debt is also a nice place at this point of time. Yes, it's a little scary given the crude and the inflation and all the other things, but it's a great asset class to be in when things are a little hazy out there, especially for the very short to medium term. So anything less than a year, I would say put some combination of debt into, because one, it allows you to take advantage of market falls like what's happened in the last 15-20 days. Number two, if you look at your overall asset allocation, debt does give you a bit of a cushion. And I think that's important from an individual investor perspective.
Okay. Raghav, just quick follow-up. This is a strategy for all times, or do you believe the current volatility and the current uncertainty demands that there should be some changes to this approach? No,
I'm reasonably okay, Neeraj. I think it's not okay. It's all right. I mean, if let's say we were in 2013-14, maybe I would have put a little more emphasis on the mid cap and the small cap space. If with those kind of valuations, given the current valuation move in the especially last couple of years, that's why I'm giving a slightly longer time horizon. Maybe if we were in different circumstances, my timing would have been a little off. I would have possibly, if I had the benefit of lower valuations, I would have possibly put a slightly lower timeline. But to my mind, Neeraj, I think the best, and we've discussed this ad infinitum, the best timeline is actually forever.